back when the volatility really got going for this market in early February, it was really concentrated in S&P 500 stocks. And sort of unusually, the tech stocks were actually less volatile. That's flipped. At one point today, tech stock volatility relative to S&P 500 at a 13-year high. What's going on?
Yeah, it blew out to it. It ended at about a little over 7 vol points, I believe, the spread between VXN and the VIX. But then since it came in, it was at 9, above 9 at one point today, and that's high since, I believe, August 2004. And what kind of that speaks to, I think, is both events very different in terms of the February vol blow up and now this tech blow up, but they're both very equity-centric blow ups. They're, Mike Purvis at Whedon said, micro is the new macro for markets, and that seems to be what's played out in both these little incidents.
Well, in fact, let's skip ahead because we also have a chart that speaks to this idea of equities as the new macro. So equity vol versus rates vol, #BTV 1577. I think we have that chart. This is really weird, right? So it's like all concentrated in equities, and we're not seeing it in currencies or rates or anything like that. What's going on there?
It's very bizarre, and when you look at kind of trading action like today, if you told me, the curve would bull flatten, we'd get, the 10-year yield going down, we'd have 2s, 10s pressing cycle lows, and the KBW Bank Index would hold up, but still equity vol rising, tech stocks selling off. I think it speaks to just how very much localized this is in terms of a re-rating of tech based on, why are we going to pay so much for future earnings when there's this regulatory specter kind of hanging over the space.
And and this is just looking this chart. This is at SIBO 5-month volatility futures versus the Merrill Lynch option the MOVE index. That's like the Treasury VIX, basically.
Yeah, and you can see it. This is a chart I borrowed from Mike Purvis at Whedon, and you can see it really starts to gear up, and they really start to diverge at about the time the Facebook allegations come to light. So that shows that this round of longer dated vol approaching those February highs is really a tech-centric event.
Let's go back to those tech stocks, because one thing, and you don't really see this very much, but I guess there's like VIX-like measures for individual stocks like Amazon and Microsoft and stuff like that. What's that all about?
Yeah, so there are some single stock options, VIX-related indexes, and Goldman Sachs has one, for instance, but Alphabet has one, Apple has one, Amazon has one. The average of those 3 VIXs for the tech-centric names at its highest level since about February 2016, pressing multi-year highs. And so when you think about you'd hear stories about, the VIX elephant or 50 Cent or guys kind of hiding out or hedging in, just SPX vol or VIX calls or things like that. This more shows that maybe folks are looking to hedge more in single names in terms of playing the tail risk for markets. And that's something I was speaking to, Dave Roberts, independent vol trader. And that's something he brought up of maybe kind of this hedging activity is now reflected more in the single names than the VIX, and the VVIX kind of off its highs, not really screaming. So that kind of speaks to it too.
So is there a common thread that unites what we were seeing now versus early February? Because it feels like the story just keeps shifting a little bit. I remember in early February it was about fears of higher inflation and those short VIX notes. Now we're not talking about the short volatility trade. Now it's concentrated in tech, and rates are going down. It just feels like, yes, there is this overall vol cloud that has picked up over the last 2 months, but it feels like the tenor of it has really changed, hasn't it?
Yeah, I was rereading some of your work from October 2014, and you were talking about, we were getting the S&P 500 index was right around its 200-day moving average. The story seemed to flip from extreme optimism to extreme pessimism very quickly, but yet the underlying macro stories weren't changing. I was like, hey, this reminds me a heck of a lot with what we're doing right now.
Great. Well, I'll have to go back and read that myself.